You know what nobody's talking about? The chart pattern that's been forming for the past 45 years. Not months, not years, decades. And if you understand what this means, you're looking at one of those rare moments in financial history where everything aligns. Let me show you something that'll change how you think about precious metals forever. Right now, silver is sitting at a critical inflection point. We're talking about a cup and handle pattern that started forming back in 1980. Think about that for a second. A technical formation that's been building for nearly half a century. The cup took 40 years to form. The handle? That's what we've been living through for the past several years. And we're right at the breakout point. Here's why this matters more than any other chart you'll see this year. When you look at silver's price history, you see two massive spikes. One in 1980, when the Hunt brothers tried to corner the market and silver hit $50 an ounce. Then again in 2011 during the financial crisis aftermath when it touched $49. Between those peaks and now, you've got this massive rounded bottom. That's your cup. Classic technical analysis, but on a time frame most traders never even consider. The handle formed as silver consolidated between 2020 and recently, building energy like a coiled spring. And here's what makes this different from every other breakout you've seen. The fundamentals backing this technical pattern are absolutely explosive. Let's talk about what's really driving this. Silver isn't just a monetary metal anymore. It's become critical industrial infrastructure. Every solar panel needs silver. Every electric vehicle uses significantly more silver than traditional cars. 5G networks, medical devices, water purification systems. The industrial demand alone has created a supply deficit that's getting worse every single year. But here's where it gets interesting. While industrial demand keeps climbing, mine production has been essentially flat. We're not discovering major new silver deposits. The easy silver has been mined. What's left is deeper, harder to extract, more expensive to process. Meanwhile, existing mines are depleting. You've got this widening gap between what the world needs and what miners can produce. Now layer on top of that the monetary demand. Central banks around the world have been accumulating gold at record pace. Everyone sees those headlines. What they're not seeing is the parallel move happening in silver. Institutional investors are finally waking up to silver's dual nature. It's both an industrial commodity and a monetary metal. That combination doesn't exist anywhere else in the periodic table. Think about what happened when gold broke out of its own multi-decade pattern. It didn't just edge higher, it exploded. We saw gold go from around $1,200 to over $2,000 in a relatively short period. Then it consolidated, built another base, and recently pushed even higher. Silver historically follows gold, but with much more volatility. The gold-to-silver ratio tells you everything you need to know. For most of human history, that ratio sat around 15 to 1. 15 ounces of silver bought you 1 ounce of gold. That made sense because silver was roughly 15 times more abundant in the Earth's crust. But in recent years, that ratio has been wildly distorted. We've seen it spike to 80 to 1, even 90 to 1 during certain periods. Right now, it's still elevated compared to historical norms. What does that mean? It means silver is undervalued relative to gold by a massive margin. And when that ratio starts compressing back toward historical averages, the move in silver will be violent. We're not talking about a gentle rise. We're talking about the kind of price action that creates generational wealth for people positioned ahead of it. Let me give you a real example of how this plays out. Back in 2008, during the financial crisis, silver dropped to around $9 an ounce. People were panicking, selling everything. But a small group of investors who understood the fundamentals started accumulating. They saw the same thing we're seeing now: a massive supply-demand imbalance, monetary instability, and a technical setup that was too perfect to ignore. By 2011, silver had climbed to $49. That's a 444% gain in less than 3 years. The people who bought at $9 and held through the volatility made life-changing returns. But here's what's crucial. That move happened when the fundamentals were actually weaker than they are today. Industrial demand wasn't nearly as strong. The supply deficit wasn't as severe. The monetary system wasn't as fragile. Today, every single factor that drove that 2011 rally is present but amplified. The industrial demand is structural, not cyclical. The supply deficit is worsening, not improving. The monetary instability is global, not regional, and the technical pattern is bigger, longer, and more powerful than anything we saw back then. Now, I want to address something important here because this affects a lot of people watching this. If you're sitting on retirement savings, if you've got a significant amount in traditional accounts, you need to understand how precious metals fit into wealth preservation. I'm not talking about speculation. I'm talking about protecting what you've already built. A lot of folks don't realize you can hold physical precious metals inside retirement accounts. Gold IRAs, silver IRAs, they're structured to give you exposure to physical metal while maintaining the tax advantages of retirement accounts. I put together a comprehensive guide on how this works, the rules, the process, everything you need to know. It's completely free, links in the description. If you've got $100,000 or more in retirement savings, it's worth understanding your options here. All right, back to what's happening in the market right now. The breakout we're seeing isn't just technical. It's being driven by real measurable changes in the physical market. Let me walk you through what's actually happening on the ground. The COMEX, that's the major exchange where silver futures trade, has been seeing massive delivery demands. Normally, futures contracts get rolled forward. Traders don't actually want physical metal, they just want price exposure. But increasingly, we're seeing contracts stand for delivery. People want the actual metal. That's creating stress in the system because the COMEX doesn't have unlimited physical silver sitting in vaults. At the same time, premiums on physical silver have been elevated for months. When you go to buy actual coins or bars, you're paying significantly more than the spot price. That premium represents the real supply-demand dynamic. Paper silver might trade at one price, but physical silver trades at a premium because there's not enough to go around. This disconnect between paper and physical markets is critical. It's the same thing we saw before previous breakouts. The paper market can suppress prices temporarily through derivatives and leverage, but eventually, physical demand overwhelms the paper games. When that happens, prices don't rise gradually. They gap up violently as the market reprices to reflect actual scarcity. We're seeing this play out in real time with delivery delays. Try to order significant quantities of physical silver right now. You're looking at extended wait times from major dealers. That's not normal. That's a sign that the supply chain is stretched thin. Mints are running at capacity. Refiners are backed up. The physical market is tight. And here's what makes this moment different from past cycles. The buyers aren't just retail investors. We're seeing institutional accumulation. Family offices, hedge funds, sovereign wealth funds. These are sophisticated players with deep pockets and long-time horizons. They're not buying silver to flip it next month. They're buying it as a strategic allocation because they see what's coming. What are they seeing? Let's talk about the macro picture. The global monetary system is under stress like never before. We've got debt levels that are mathematically impossible to repay. We've got central banks that have painted themselves into a corner. They can't raise rates without crashing the economy, but they can't keep rates low without destroying the currency. It's a trap with no good exits. Every major economy is dealing with the same problem. The US, Europe, Japan, China. They've all relied on debt expansion to fuel growth. But there's a limit to how much debt an economy can handle. We're approaching that limit, and the consequences are starting to show up in currency markets. Look at what's happening with the dollar. For decades, it's been the world's reserve currency, unchallenged. But that's changing. Countries are starting to settle trade in their own currencies. They're reducing dollar reserves. They're buying gold and silver as alternatives. This isn't conspiracy theory stuff. This is official policy from major nations. The BRICS countries, that's Brazil, Russia, India, China, South Africa, they've been openly discussing alternatives to dollar dominance. They're creating new payment systems. They're encouraging commodity-backed trade. They're accumulating precious metals at unprecedented rates. This is a structural shift that's going to play out over years, but the early moves are happening right now. When the world's reserve currency starts losing its privileged position, what happens? Capital flows into hard assets, things that can't be printed, can't be debased, can't be manipulated by central banks. Gold and silver have been money for thousands of years. They'll be money long after today's fiat currencies are forgotten. Here's a story that illustrates this perfectly. In the 1970s, the US was dealing with similar problems. Inflation was running hot. The dollar was losing purchasing power. people were losing faith in paper currency. Gold was still fixed at $35 an ounce by government decree, but that peg was becoming impossible to maintain. In 1971, Nixon closed the gold window. He ended the dollar's convertibility to gold. It was supposed to be temporary. It became permanent. And what happened next? Gold went from $35 to over $800 by 1980. That's a 2,200% increase in less than a decade. Silver did even better. It went from around $1.50 to $50. That's a 3,200% gain. The people who understood what was happening, who positioned themselves in precious metals before the breakout, they preserved and multiplied their wealth while everyone else watched their purchasing power evaporate. We're in a similar setup today, but the scale is much larger. The debt is bigger. The monetary distortions are more extreme. The potential moves in precious metals are correspondingly larger. Now, let's talk about the technical side of this in more detail because the chart is telling us something important. That cup and handle pattern I mentioned earlier, it's not just some random formation. It represents decades of accumulation. Smart money quietly building positions while the crowd ignores silver. The cup shows you the long-term base building. The handle shows you the final consolidation before the breakout. When you see a pattern like this on a multi-decade time frame, the measured move is enormous. Technical analysts calculate targets by measuring the depth of the cup and projecting that distance from the breakout point. In silver's case, we're talking about potential targets that would put silver well above its previous all-time highs. But here's what most people miss. The breakout doesn't happen in a straight line. There will be volatility. There will be pullbacks. There will be moments where it looks like the move is over. That's when weak hands get shaken out. That's when people who don't understand the bigger picture sell at exactly the wrong time. The strong hands, the people who understand the fundamentals and the technical setup, they use those pullbacks to add to positions. They know that the overall trend is up, and they're willing to endure short-term volatility to capture the long-term move. Let me give you another historical example. In the early 2000s, gold was trading around $250 an ounce. It had been in a bear market for 20 years. Everyone thought precious metals were dead, relics of the past. But a small group of investors saw the same things we're seeing now: excessive debt, monetary expansion, geopolitical instability. They started accumulating gold when nobody wanted it, and they held through the volatility as gold began its bull market. There were plenty of scary moments, pullbacks of 20%, 30%, times when it looked like the rally was over. But they understood the bigger picture. They knew the fundamentals were driving the move, not just speculation. By 2011, gold had reached $1,900. That's a 660% gain from the lows. The people who bought early and held through the volatility made fortunes. But more importantly, they preserved their wealth during a period when paper assets were getting destroyed. Silver did the same thing, but with even more volatility. It went from around $4 to $49. That's over 1,000% in the same time frame. The moves were violent in both directions, but the overall trend was unmistakable. Today we're at the beginning of what could be an even larger cycle. The fundamentals are stronger. The technical setup is more powerful. The catalysts are more numerous and more severe. Let's talk about some of those catalysts specifically. The green energy transition is going to consume massive amounts of silver. Every solar panel requires about 20 grams of silver. Sounds small, but when you're talking about billions of solar panels being installed globally, that adds up fast. Current estimates suggest solar demand alone could consume over 200 million ounces of silver annually within a few years. That's roughly 20% of total annual supply. Electric vehicles use significantly more silver than traditional cars. The wiring, the electronics, the charging infrastructure, all of it requires silver. As EV adoption accelerates, that demand is going to spike. We're not talking about a gradual increase. We're talking about exponential growth in a market that's already in deficit. 5G networks are another massive demand driver. The infrastructure build-out requires silver for its superior conductivity. Medical applications are expanding. Silver's antimicrobial properties make it essential for certain medical devices and treatments. Water purification systems increasingly rely on silver. All of these industrial uses are structural, not cyclical. They're not going away if the economy slows down. They're part of the infrastructure of the modern world, and they're all competing for a limited supply of silver. On the supply side, the picture is even more constrained. Most silver comes as a byproduct of other mining operations. Copper mines, lead-zinc mines, gold mines. Only about 30% of silver production comes from primary silver mines. That means silver supply is largely dependent on the economics of other metals. If copper prices fall, copper mines slow production, and silver supply drops as a consequence. Miners can't just ramp up silver production in response to higher silver prices because most of them aren't primarily silver miners. This creates a supply response that's much slower and more constrained than in other commodity markets. We're also seeing grade depletion at existing mines. The easy, high-grade deposits have been mined. What's left is lower-grade ore that's more expensive to process. This puts a floor under silver prices because below certain levels, it's not economical to mine. But it also means that even with higher prices, supply response is limited. New mine development takes years, sometimes decades. You can't just decide to open a silver mine next month. You need to find the deposit, prove the reserves, get permits, build infrastructure, hire workers. By the time new supply comes online, the market dynamics have often shifted dramatically. All of this creates a situation where demand is growing rapidly and supply is constrained. That's the recipe for a sustained bull market, not just a short-term spike. Now, let's talk about what this means for the gold-silver ratio, because this is where things get really interesting. Throughout history, silver has been valued at roughly 15 to 20 times less than gold. That ratio made sense based on relative abundance and utility. But in recent decades, that ratio has been distorted. We've seen it spike to 80, 90, even 100 to 1 during certain periods. Right now, even after silver's recent strength, the ratio is still elevated compared to historical norms. What happens when that ratio starts compressing back toward historical averages? The math is simple but powerful. If gold is at $2,000 and the ratio is 80 to 1, silver is at $25. If that ratio compresses to 40 to 1, silver goes to $50. If it compresses to 20 to 1, silver goes to $100. And we're not even talking about gold going higher in that scenario. If gold continues its own bull market while the ratio compresses, the moves in silver become exponential. This is why silver is often called the poor man's gold. It gives you leverage to the precious metals bull market. When gold moves 10%, silver often moves 15% or 20%. The volatility cuts both ways, but in a bull market, that volatility is your friend. Here's what sophisticated investors understand. You don't have to choose between gold and silver. You hold both. Gold is your stable wealth preservation anchor. Silver is your higher risk, higher reward play on the same fundamental thesis. Together, they give you a balanced exposure to the precious metals sector. Let me tell you about what's happening in the physical market right now because this is where theory meets reality. Coin dealers are reporting unprecedented demand, not just from retail investors but from high net worth individuals buying in bulk. We're talking about orders of thousands of ounces at a time. These aren't speculators hoping to flip for a quick profit. These are wealthy families allocating serious capital to physical precious metals. The premiums tell you everything. When you can buy paper silver for one price, but physical silver costs significantly more, that's the market telling you where the real value is. Paper can be created with a keystroke. Physical metal has to be mined, refined, fabricated, and delivered. There's a real cost and real scarcity. We're also seeing interesting developments in the vault space. Secure storage facilities are expanding capacity to meet demand. That tells you institutional players are accumulating and need places to store large quantities of metal. This isn't retail investors buying a few coins. This is serious money moving into the sector. The ETF flows are another indicator. Silver ETFs have been seeing consistent inflows. That represents investor demand that's being met with paper claims on silver rather than physical delivery. But here's the thing. Those ETFs are supposed to be backed by physical metal. As inflows continue, they have to buy physical silver to back those shares. That creates additional demand in an already tight market. Some analysts are concerned about whether these ETFs actually have all the physical metal they claim. There have been questions about auditing practices and whether the same bars are being counted multiple times across different funds. If those concerns are valid and there's ever a rush to redeem ETF shares for physical metal, the resulting squeeze could be spectacular. This brings us to the COMEX situation, which is fascinating if you understand how it works. The COMEX is primarily a paper market. Futures contracts trade in massive volumes, but most of them never result in physical delivery. Traders roll contracts forward or close positions before delivery. The system works as long as everyone plays by those rules. But what happens when a significant number of contracts stand for delivery? What happens when people actually want the physical metal? The COMEX has to deliver, but their vaults don't hold unlimited quantities. They rely on the assumption that most contracts won't demand delivery. We've been seeing increasing delivery demands. Not enough to break the system yet, but enough to create stress. Vault inventories have been fluctuating. Eligible versus registered metal. The categories matter because only registered metal can be used to satisfy delivery demands. If we ever reach a point where delivery demands exceed available registered inventory, the COMEX would face a serious problem. They'd have to either find more physical metal, which would drive prices higher, or they'd have to change the rules, which would destroy confidence in the paper market. Either scenario is bullish for physical silver prices. In the first case, prices rise to attract supply. In the second case, investors flee paper markets for physical metal, driving premiums even higher. This is why some investors prefer to hold physical metal directly rather than paper claims. You eliminate counterparty risk. You know exactly what you own. Nobody can change the rules on you or fail to deliver. Let's talk about the geopolitical dimension because this is becoming increasingly important. We're living through a period of significant geopolitical realignment. The post-World War II order is breaking down. New power centers are emerging. Old alliances are being questioned. And through all of this, precious metals are playing a crucial role. Countries that want to reduce their dependence on the dollar are accumulating gold and silver. They're building reserves that can't be frozen or sanctioned. They're creating alternatives to the dollar-based financial system. This isn't happening overnight, but it's happening steadily. When Russia was hit with sanctions, one of the first things they did was increase gold purchases. They wanted reserves that couldn't be touched by Western financial systems. Other countries watched and learned. If it can happen to Russia, it can happen to anyone. Better to have assets that are outside the traditional banking system. China has been accumulating gold for years, likely silver too, though they're less transparent about that. They're building a position that gives them options. If the dollar weakens, they're protected. If there's a monetary reset, they're positioned. They're playing a long game, and precious metals are a key part of their strategy. Even smaller countries are diversifying reserves. They're reducing dollar holdings and increasing gold allocations. This is a trend that's been accelerating, and it has profound implications for precious metals prices. As official sector demand increases, that's demand that's not price sensitive. Central banks aren't buying gold and silver to make a profit. They're buying for strategic reasons. They'll continue buying regardless of short-term price movements. That creates a floor under prices and a steady source of demand. Now, I want to address something that comes up a lot: the question of price manipulation. There have been documented cases of banks manipulating precious metals prices. Major financial institutions have been fined for spoofing and other manipulative practices in the gold and silver markets. This isn't conspiracy theory. This is established fact with legal settlements to prove it. The question is, does manipulation still happen? And if so, what does it mean for investors? Here's the reality. Manipulation can suppress prices temporarily, but it can't overcome fundamental supply and demand forever. If anything, artificial price suppression creates an even more explosive situation when the fundamentals finally overwhelm the manipulation. Think of it like holding a beach ball underwater. You can do it for a while, but it takes constant effort. The moment you let go, that ball shoots to the surface with tremendous force. If silver prices have been artificially suppressed while fundamentals have been improving, the eventual move higher will be that much more violent. For investors, this actually creates opportunity. If prices are being held below where fundamentals suggest they should be, that's a gift. It's a chance to accumulate at artificially low prices before the market corrects. The key is understanding that the manipulation, if it exists, is a short-term factor. The long-term trend is determined by supply, demand, and monetary conditions. Those fundamentals are overwhelmingly bullish for silver right now. Let me bring this back to the chart pattern we started with because everything I've talked about is reflected in that technical setup. That 45-year cup and handle isn't just a random pattern. It's the visual representation of decades of accumulation, consolidation, and preparation for the next major move. The cup shows you the long-term base. The handle shows you the final shakeout before the breakout. We're right at the point where the handle meets the breakout. This is the moment where patient investors get rewarded and latecomers start chasing. This is where the move accelerates and the gains start compounding. The measured move from this pattern suggests targets that would take silver well beyond its previous highs. We're not talking about modest gains. We're talking about the potential for silver to reach levels that most people think are impossible. But here's what you need to understand. This isn't going to happen overnight. Bull markets take time. There will be volatility. There will be corrections. There will be moments of doubt. That's normal and healthy. It's how bull markets work. The people who make life-changing returns are the ones who understand the bigger picture and don't get shaken out by short-term noise. They're the ones who use corrections to add to positions rather than panic selling. They're the ones who have conviction based on fundamentals, not just hope based on price action. This is why education matters. This is why understanding what's really happening in the precious metals market is so important. When you know why silver is moving, when you understand the forces driving the trend, you can hold through the volatility. You can make rational decisions instead of emotional ones. The chart is showing you a once-in-a-generation setup. The fundamentals are confirming what the technicals are suggesting. The catalysts are in place. The supply-demand imbalance is real and growing. The monetary instability is accelerating. The geopolitical shifts are happening. Everything is aligning for a major move in silver. The question isn't whether it's going to happen. The question is whether you're going to be positioned for it when it does. This is one of those rare moments in markets where you can see what's coming. The evidence is overwhelming. The pattern is clear. The opportunity is sitting right in front of you. What you do with that information is up to you, but years from now, you'll look back at this moment and realize it was obvious. The people who act on obvious opportunities before they become obvious to everyone else, those are the people who build real wealth.